It's time now for On the Radar. It's when we ask an investing professional what they're looking at in today's markets. And this week is action-filled. We have monetary policy decisions out of the U.S., Europe, the Bank of England. They're all expected to conclude their final monetary policy updates for the year. Our next guest believes markets are poised for a year-end rally, but the Fed could spoil it all. For more on the macro environment this week, we're joined by Allan Small, Senior Investment Advisor at Allan Small Financial Group, IA Private Wealth. There is just so much going on. We have the CPI data tomorrow, and then I mentioned there's all the monetary policy decisions in those key regions and also just around the world. Obviously, everyone's tuned in very closely to the U.S. Federal Reserve and have priced in about a 50 basis point move. What are the chances the Fed will surprise us, to the upside or the downside on that?
Yeah, I guess there's always a chance. I think earlier in the year, Bank of Canada, when they went a full percentage point, I think that was a big surprise. The hope is that they won't surprise us, because if they do, that's when the market brings in this whole uncertainty factor, and the market obviously does not like uncertainty. And we could see a downturn if it were to be a 75 basis point hike. But I think overall, we should see the 50. It'll all come down to what Jerome Powell says, after his announcement. Will they say that they're going to continue to slow down the pace of hikes into the new year? Will they say that they need to continue the rapid pace and keep those rates rising by at least 50 basis points? Or, I think a lot of people think they're going to start to pull back and maybe go only 25 in the new year. So I think a lot's going to come down to what he says, how he says it. As we all know, everybody's going to parse through every word of his commentary. But I don't think he's going to surprise. I think everyone's expecting 50, and I think that's what he's going to deliver. Right.
Janet Yellen was commenting that she thinks inflation will be, quote, much lower at the end of next year. Now, we get the CPI data tomorrow from the United States. She also has a lot of reason to try to downplay inflation expectations. Do you think that could be a reality, that we've peaked and inflation will be much lower next year, or is that wishful thinking or an attempt to potentially impact the psychology
yes.
of Americans?
Well, I think overall, I think she has some valid points. You see, for me, I think the inflation rate being as high as it is based on the supply side of the equation, not necessarily the demand side. And so we need to get more supply. And I think what Janet Yellen has said before is that when supply chains have reopened and things are flowing better, that should definitely help bring down the inflation rate quicker. And I agree with that. You see, the Fed, Bank of Canada, really their main, choice, or their only thing they can do to bring down inflation is to raise interest rates to dampen the demand, to slow down the demand, which then perhaps takes us into a slowdown, significant, maybe a recession. But I think we need to do the opposite, actually. I think we need to increase supply to meet the higher demand versus bring down the demand to meet the lower supply. And I think if we can do that, that would be better off. Here we are, 6.9% on the inflation rate in our country. We have 7.5% in the U.S. They've been raising rates, 6, 7 times this year, and still at an elevated level. I think everybody's worry is that if they continue on this pace, inflation at some point will come down, but so will the economy. So maybe work on the supply side. And I think what Janet Yellen is saying is now that China hopefully is back online, those supply channels are back to being at least reopened, maybe 75%, maybe not fully, but those supply chains are looking a lot better, that we'll start to see inflation fall a lot quicker.
You mentioned that, and we mentioned in the introduction, that you believe that the so-called Santa rally really does hinge on the Federal Reserve's decision on Wednesday. I was reading some commentary out of Goldman Sachs and Morgan Stanley. They issued separate notes indicating that they believe CPI, so inflation and the Fed, is quote-unquote yesterday's news. And they posit that the real mover, the thing that people need to be focused on most right now is on the potential for earnings revisions out of companies, that margins are going to get very squeezed, and that is the biggest risk to equities. What's your reaction to that?
I agree with that. I think that could be the biggest thing for earnings in the new year. I think the Santa Claus rally still may happen for this year. But I think what they're estimating or predicting is that earnings will slow down. And with the economy slowing down, corporations are already saying that things aren't looking as rosy as they looked a year ago, and that they're taking down their earnings expectations for the foreseeable future. So I think that's why a lot of analysts are saying we're going to be in tough for the first couple of quarters next year. When companies start to say, listen, growth is definitely slowing down, we're not seeing as rosy a picture as we did a year ago, that all of a sudden these share prices will start to pull back to reflect or come in line with a slowing growth environment. So I think next year, the first few quarters, we could see that. That's why I guess if you're looking at, if you're an investor at that point, you may want to look to dividend payers, get paid a little dividend while you wait for the growth, perhaps in the second half of next year. But I still believe a Santa Claus rally is all about the Fed. If they come in as expected, the market has already factored in about a 50 basis point increase. We could see a rally towards the end of the year and then have to deal with slowing growth perhaps in the first quarter or two next year. So I definitely agree with what Goldman Sachs and Morgan Stanley are saying. I think companies will be in tough next year because of a slowing economy, because of a higher interest rate environment, higher for longer, which is a lot different than what we say is lower for longer. Now we're going to see a higher interest rate for longer, and companies are just going to have to cope with a new environment.
Really quickly, Tiff Macklem, the chair of the Bank of Canada, is speaking later today. It's a fireside chat. Are you listening for anything specific in the way that we parse Jerome Powell's comments?
Well, I think Jerome Powell really is the one we're looking at more so. I know head of the Bank of Canada, obviously important for us here, important for interest rates, important for our dollar. Stock market usually moves more with what the Fed says than what the Bank of Canada says, unfortunately or fortunately. But it'll be interesting to see what he says. A pause perhaps coming sooner than what we're going to see in the U.S. That could be on the table. So we'll see if we can get some hints for perhaps a pause early in the new year.